Hedge funds are at it again with the return of a high-risk trading strategy that has the potential to blow up the entire Treasury market. Bank of England recently warned about the staggering growth in this trading strategy, in which hedge funds have built up a massive leveraged position that is far larger than it's been in the last decade. This is a specific type of the age-old relative value trade. This one is called the basis trade. This has people concerned because hedge funds are leveraged up to 50 times their own capital, and in a disorderly unwind, treasury markets can literally be forced to seize up. But if we want to understand what's actually going on here and what's really at risk, we have to understand how this trade actually works. And there are four fundamental foundational concepts that we need to understand first before we can wade our way into the basis trade. The first foundational concept is going to be arbitrage. The definition of arbitrage is the simultaneous buying and selling of securities, currency, or commodities in different markets or in derivative forms in order to take advantage of differing prices for the same asset. Now, if that sounds like financial mumbo jumbo to you, don't worry. An easier way to understand what arbitrage is by looking at a side hustle that is growing in popularity today, garage sale flipping. Let's say you're looking through Facebook Marketplace or OfferUp through the free section and you stumble on, I don't know, a Tickle Me Elmo or a kid's bicycle that is posted for free or maybe $5. You know you could sell that same thing on eBay for $50, but you don't want to bear the cost of buying that thing or going and picking it up if you don't know for sure you can sell it. So you go on eBay, you make the listing, you put up some stock photos of the item, and you post it for sale. A day later, your sale comes in. Somebody buys the bicycle from you. So at the very same time that you get the sale, you go and you message the owner of the one you saw on Facebook Marketplace and you say, hey, I'd like to go pick it up. And you pick it up and then you put it in the mail to deliver to the person who bought it from you on eBay. Now, that's not exactly the same thing as what is happening in financial markets, but it's close enough that you understand the concept. You are taking advantage of a price discrepancy of the exact same thing, and so you're gonna buy it and you're gonna sell it for the differing price, and you as the middleman, you're gonna take the difference. So that's arbitrage. The second foundational concept we need to understand is shorting. What does it mean to short something? Well, the definition of selling something short is to sell a stock or another security which you do not own at the time in the hope of buying it back at a lower price before the delivery time. Again, a little bit of financial mumbo jumbo there, so let's break it down simple. The first question anybody has when being introduced to the concept of short selling is, how in the world do you sell something before you actually own it? And the answer is, you borrow it. So let's say your friend has an iPhone 12 that they just have sitting in their closet as a backup just in case they need it. So you go to your friend and you say, hey, I know you're not using that iPhone. Can I borrow it from you for 6 months? Because you in your head, you know Apple's gonna be coming out with a new iPhone in about 6 months. So your friend says, yeah, I'm not using it. Go ahead and borrow it from me. But if I need it, then you have to give it back as soon as I ask for it. And you say, okay, that's fair. So you take the iPhone 12, you go and you sell it online and you pocket $500 for it. Well, 6 months later, just as you expected, Apple comes out with the new iPhone and all the older iPhones are now cheaper because they're 6 months older and there's a new iPhone now. So you go buy the exact same model of iPhone 12 on eBay and now it's only $400. You get it in the mail, you hand it back to your buddy. He's none the wiser because he essentially has the exact same thing back and you just engaged in a successful short sale. First you borrowed something, then you sold it. The price went down, you bought it back and delivered back the thing that you owed. Obviously, if Apple, for whatever reason, said, hey, we are not going to be making iPhones anymore, then it's possible that iPhones that are old would become more valuable because now they're collector's items. And you could have been very wrong. And instead of buying back that old iPhone 12 at $400, maybe you'd have to pay $1,000. And because you sold it first at $500, then bought it back later at $1,000, you would have lost $500 on the deal. The third foundational concept we need to understand here is a relative value trade. A relative value trade is a strategy that seeks to take advantage of price differences between related financial instruments by simultaneously buying and shorting the different securities, profiting from the relative value of the two. You know the drill, financial mumbo jumbo, so let's break it down in a more easy to understand way. This is a chart of SPY, the most popular ETF that tracks the S&P 500. And this is a chart of RUT, an ETF that tracks the Russell 2000. Now the S&P 500 is the 500 largest companies for the most part, and the Russell 2000 makes up the small cap companies in the United States. Both of these are different measures of the stock market. One is big companies, one is smaller companies, but usually these are used in conjunction with each other inside of a well-diversified portfolio. Most asset managers, investment advisors, and total market portfolios will have an allocation to both. This means that when we look at both of these funds compared to each other, the blue line is SPY and the orange line is RUT, we can see that there are certain periods of time in which the S&P 500 outperforms the Russell 2000, yet there are other periods of times where the Russell 2000 outperforms the S&P 500. For the most part, over a long enough time horizon, the performance is going to be generally the same. They're going to track together because they have generally the same amount of money being invested in them and taken out of them. The economic drivers that cause the success of the largest companies that are in the S&P 500 are generally the same that cause the success of the companies in the Russell 2000. Yet there are times where even though the general performance over the long term is quite similar, there are short periods of time where the performance is very different. So one relative value trade would be to short the S&P 500 and buy the Russell 2000, or vice versa. If we take a look at the difference in performance of these funds since June of 2021, about 2.5 years ago, we can see that the S&P 500 is up about 8.5%, while the Russell 2000 is down about 19%. So if you were betting on a reversion to the mean, you would buy the Russell 2000 here and you would short the S&P 500. Because you're shorting one thing, you're borrowing those shares to sell them, you're actually getting cash for that. You're going to use that cash to make the purchase. So this is going to result in $0 outlay from you. The second thing to note is that you don't actually care whether both of these go up or down. The only thing that you're betting on is that the performance gets more similar. In other words, there's a reversion to the mean and the Russell 2000 outperforms the S&P 500, or the S&P 500 underperforms the Russell 2000. If they both move up together simultaneously or both move down together simultaneously, your profit and loss doesn't change. In this specific relative value trade, you're just betting on the fact that the Russell 2000 will outperform the S&P 500, whether they both move up, the Russell just moving up more, or whether they both move down, the S&P moving down more. In a reversion to the mean, since over the long term, generally that's what happens. If we do see a convergence between the two, then you could close out your trade at a nice profit. But if the divergence between the two continues to widen and the Russell 2000 continues to underperform the S&P 500, then you may have to close out at a loss. Now, the fourth foundational concept that is necessary to understand is being long an asset while simultaneously being short a derivative of the same asset. This is a chart of Apple, and as of the time of this recording, Apple is trading at $194 per share. Apple has performed extremely well, but you are starting to get concerned that it is overvalued, and you think $200 per share is a good exit point. So you look at the 200 strike price call options on Apple expiring in a little over 1 month, and you can see that the current price is $2.88. If you sell a call, you are giving somebody else the right to buy that stock from you at the price specified in the call option contract. In this case, because the strike price is $200, you are giving somebody else the right to buy your Apple shares from you at $200 per share. They can do that anytime between now and when the option expires in a month. For that right, they're going to pay you $2.88 per share. You own 100 shares, so you're going to collect $288 for giving somebody else the right to buy your shares at $200 per share. If Apple does go up to 200, then they will buy your shares from you and you will collect the $200 per share from them as well. But if Apple doesn't reach $200, then the contract expires and you still keep that $288 you collected to sell them the call. You're happy because you get to walk away with that income, and the other person who bought that call from you is also happy because they only had to spend $288 and they avoid avoided buying the shares because they only want to buy them if those shares were going to go up a lot. And now that the shares didn't go up a lot, they get to walk away without owning the shares at all. They paid you for the right just in case the shares go up, but they didn't, so now they get to walk away clean. So we have those 4 foundational concepts down now: arbitrage, shorting, relative value, and being long an asset and then being short a derivative of that asset. Right now, hedge funds are using a trading strategy to exploit the discrepancies in the US Treasuries market, and it is called the basis trade. This trade involves heavy borrowing, and if there is an unexpected event, this trade can blow up and cause funds to sell all of their treasuries all at once. For the next moment, I'd like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why Monetary Metals is doing something so revolutionary goes all the way back to when FDR outlawed gold ownership with Executive Order 6102. What a lot of people don't know about this gold confiscation was that it also outlawed the gold clause that was very common in debt contracts, which allowed people to get their debt paid back to them in gold if they chose. Fast forward from there to 1971, when the US left the gold standard for good. There's no longer any reason to keep this law in place. But what even fewer people are aware of is that this law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legal in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they're doing, and nobody else is. They have created a way for you to get on your own personal gold standard by paying you a yield that is denominated in gold, it's priced in gold, and it is paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you start off with 100 ounces of gold at 4%, then you end the year with 104 ounces of gold. The yield is denominated and paid in gold, regardless of what the price of gold does. Your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do. I've gotten to know the team, and as a result, I've not only become a customer of the company myself, I use the products, but I've also invested into the company personally. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and open up an account today. Well, there's a bunch of moving parts to this, so hang with me. We're going to go full circle and explain every single moving part. Part number 1 is hedge funds will buy US Treasuries. So hedge funds will take cash and they will buy an existing US Treasury. That's important, an existing one. These are called off the run. They're gonna buy an existing US Treasury from somebody else on the open market. That Treasury is an IOU that says at some point in the future, the US government is going to pay them back the principal and they collect the interest along the way. So that's part number 1, hedge funds are buying US Treasuries. Part number 2 is that hedge funds are shorting the futures of those US Treasuries. So you can see here where those foundational concepts come in. Number 1, they're shorting, and number 2, they're shorting something that is a derivative of the asset, the future of that treasury. And because these financial instruments have the same maturity, they're essentially creating for themselves a relative value trade. The only thing that they care about is the relative difference in the values between the futures of the treasury and the treasury itself. And they have no plans to ever close this out. They're just going to let it mature. Now, it's important to recognize that the profit from these price differences is tiny, sometimes as little as a fraction of a penny. That'd be like you doing your garage sale flipping and you buy something for $1,000 and then you sell it for $1,000.01. That's not going to be the ideal way to get a great return on your money. Profiting 1 cent for every $1,000 is nothing, which is why they have to borrow lots of cash in order to multiply their bets. So instead of just using their money and making 1 cent on every $1,000, they're able to borrow a ton and make that 1 penny many thousands of times over. And because they've bought something and shorted something that in theory is almost identical, and they're borrowing in private markets, they can lever themselves up to the eyeballs with this trade. And that's where the third piece comes in, the source of borrowing for most of these hedge funds engaging in this basis trade. They're borrowing from the repo market. Just a few days ago, I made a video about cracks beginning to appear in financial markets with liquidity problems showing up. After this video, I highly encourage you to watch that because there's problems showing up in the repo market here that will have implications for this basis trade. So hedge funds are borrowing in the repo market. This is important because this is short-term borrowing. Repo rates change on a day-to-day basis. And so if I'm a hedge fund, I'm borrowing money at, let's say, 5% to buy something and then also short something else. And I'm gonna pocket 1 cent every time I do that. So I need to borrow a bunch of money. But the key thing here is this only works if that repo rate doesn't change. If suddenly it becomes more expensive to hold my borrowing to the next day or the next day, I have to unwind my trade rapidly so that I can pay that back because it's no longer profitable to hold that trade. So as you can see, this can get ugly pretty quickly. But before we get into exactly how ugly this can get, it's important to point out why there's the price discrepancy to begin with, because on the surface, you might think, okay, well, that makes sense. You short the futures of the treasuries, buy the treasuries. Well, why are those things priced differently in the first place? Because if so many hedge funds are engaging in this trade, you would expect that arbitrage opportunity to be squashed. Well, it's because pension funds, insurance companies, and asset managers prefer to buy bond futures instead of the bonds themselves. This is why we see such a massive amount of money combined in asset manager positioning that is on the long side of treasury futures, while leveraged funds are so heavily on the short side of treasury futures. Because futures themselves, being derivatives, only cost a very small amount for the notional position they control. So if you're an asset manager that wants exposure to bonds, you could spend $1,000 on a bond, or you could spend $100 or less by buying the bond futures. And holding to maturity, you're going to get the exact same performance, which means that the rest of your cash is free to do something else with, like buying stocks. So asset managers, pension funds, and insurance companies are heavy on the side of buying those bond futures instead of the bonds themselves. Again, this is why the red portion of this chart, those asset managers, are so heavily long compared to the last decade. Because there's so much money buying these bond futures from asset managers, insurance companies, and pension funds, it's going to drive the price up to a small premium compared to the bond itself. And so hedge funds are taking advantage of that and providing the liquidity for all this by buying those bonds that are undervalued and shorting those bond futures which are overvalued. It's only a penny or a fraction of a penny, but it's still a difference. And finally, when asset managers, pension funds, insurance companies do buy treasuries, they're not buying the off-the-run treasuries, the ones that already exist from somebody else. They're buying the on-the-run treasuries directly from the United States government when the government issues those new treasuries, which means those funds are going to be directly loaning brand new cash to the government when the bond is issued, when that treasury is created, and they're going to get those new ones. The reason why this is significant is because this sets up a dynamic in the market where off-the-run treasuries are a lot less liquid than the on-the-run treasuries. There's always far more demand to get those new treasuries that are being newly created than there is to buy the old ones that already exist from somebody else. And that's especially true during times like 2018 and 2019, and ever since May of 2022, when the Federal Reserve is letting their balance sheet decline, which means that they are not actively buying treasuries from the open market, which would be off the run. So one of the biggest historical buyers, the Fed, is not participating in that market right now, which means that hedge funds are taking up that space of being the biggest buyers of those off the run, the existing US treasuries right now for the basis trade. As with all relative value trades, they are deemed as close to risk-free as possible because you're engaging in a trade of selling one thing and buying another thing, and those things ideally are as close to identical as you can get, and ideally they're bonds, so they're going to mature at some point. So as long as you hold that trade to maturity, there's no risk. The problem comes when you get forced to get rid of them prior to maturity. And that's exactly why this poses such a big risk to the Treasury market and the bond market overall. This trade blew up in March of 2020 in the dash for cash. This happened because the Federal Reserve did the successive emergency cuts of 50 and 100 basis points in March, which led to massive price swings. During those times, the investors prefer on-the-run bonds, even more so than they do right now, which means that hedge funds that are needing to unload the off-the-run bonds have nobody to sell them to. And as that price discrepancy gets a little bit worse, you have hedge funds running into the problem of hitting loss limits or leverage limits, hitting loss limits or risk limits. This is why Treasury markets can be caused to seize up, because all those hedge funds that are levered up to their eyeballs owning Treasuries have to sell those Treasuries all at the same time. And as I talked about in my video from a couple of days ago, we are starting to see increasing amounts of abnormal volatility in overnight repo rates. Now, right now, that's not a huge concern, but it will be a concern in the future as less and less money is available in the repo market. This will happen as the US government has to continue to borrow more and more at the very short end of the curve, which is borrowing through T-bills. The Federal Reserve is slowly seeing its reverse repo facility get drained. The faster and faster the government borrows T-bills. This is because T-bills are short-term, very liquid securities. So money market funds that are currently operating a lot in the repo market right now have more and more of an incentive to loan money to the US government instead by buying T-bills. The more this happens, the less money will be available in the repo market and the more expensive borrowing in the repo market will get, essentially just drying up liquidity and making cash, overnight cash, more scarce. This could absolutely at some point trigger an unwind of the hedge fund basis trade. And as one is forced to unwind, just like always happens historically, every time a relative value trade gets big, it forces everybody else to unwind too, because it makes the losses worse for everybody. If I'm short bond futures and long bonds with a small price difference, but I get forced to close out for whatever reason, my investors take money out, so I have to close out the trade. Well, I have to sell the thing that I'm long, which pushes down the price, and I have to buy back the thing that I am short, which pushes up the price. That makes the price difference worse, not better. For everybody else, it makes their losses worse, which means that they could get forced to unwind as well. Now, this likely is not going to blow up anytime soon. I would expect that if this blows up, it's probably going to be at least 6 months down the road. So I'm giving you a warning ahead of time. And this is because when interest rates stay stable, it allows this trade to grow. This is why we've seen this trade balloon out of control toward the end of 2023. Interest rate hikes have stopped and interest rates are staying relatively stable, especially short-term rates. And as long as market expectations are correct that the Federal Reserve will keep interest rates near the current level for the next 6 to 9 months, then we should see open interest in Treasury futures continue to rise. And the larger this trade gets, the bigger the blowup can become. And finally, there are 2 ways in which we might see this resolved if it does start to blow up rapidly. Number 1, obviously, you see the Fed return to QE. The Federal Reserve starts to increase the size of its balance sheet yet again. It will be doing so by buying Treasuries. The Fed buys off-the-run Treasuries from the open market, not directly from the United States government. And so you would have a buyer enter the market that those hedge funds could unload those underwater Treasuries to without causing massive disruptions. But as this would be an emergency and unexpected and unannounced return to QE, this would largely be seen as another bailout by the Federal Reserve in the markets, specifically for hedge funds, since they're the ones that wouldn't have to sell at such of a steep loss. And they would probably have a difficult time communicating to the markets that the whole markets could have blown up. And if they do, then there will be increased call for more regulations on hedge funds. The second solution was talked about in a recent thread on this topic by Andy Constan at Damped Spring on X, in which he talked about the Treasury buyback program. The US Treasury regularly engages in something called Treasury buybacks, and it's essentially just the United States government itself buying back existing debt. And obviously, since the government doesn't run a surplus, they do that by issuing new debt. So they borrow new debt to buy back old debt. You can see all of their past buyback announcements, and you can see that pretty much every year they do 1 or maybe 2 Treasury buybacks. And they've been doing that since 2014 consistently in what they call small value buybacks. And the stated reason for this is just to test operational readiness, not for any actual debt debt management need. Basically, they are staying vigilant just in case they ever have to do this as a wide-scale operation. Essentially, this amounts to a credit card balance transfer where you open up a new credit card, transfer your balance to the new credit card from the old one. They're just taking on new debt in order to pay off that old debt. But given the fact that this would be a direct bailout of hedge funds, even though it would save the entire treasury market, this would be viewed as unprecedented intervention in financial markets by the treasury itself, whereas there's more precedent for the Federal Reserve doing that. And so I wouldn't expect this to be the very first thing that happens. Now, whenever you have massive disruption in something like the treasury market, which is supposed to be the safest and most liquid market in the entire world, that bleeds over into every market, bonds for corporations, and also the stock market. Now, I don't try and time these things happening in the market because if they blow up, you have no idea when they're going to blow up. And so I like to construct my portfolio in a way that has little tiny bets that will profit large if something like this happens, but overall is not reliant on something like that and is actually robust against big disruptions in the market. This is exactly what I teach members of Heresy Financial University to do. And people who just maintain passive investing in a couple index funds and bury their head in the sand, they're the ones that are going to get hurt, sitting on massive losses and then having to wait years for it to just come back up to break even. If you'd like to learn how to do just that, join Heresy Financial University before the end of the year, because right now you can get it at a 67% discount compared to what it'll be starting January 1st. It will never be this price again. Use code LASTCHANCE2023. Link is in the description below. As always, thanks so much for watching. Have a great day.